Imagine you're sitting at your kitchen table, scrolling through your brokerage app, and you see your portfolio down 15% this year. Your stomach drops. Your spouse asks how the investments are doing, and you mumble something about staying the course. Meanwhile, your coworker just told you he made 40% trading AI stocks last month, and you're wondering if you're the idiot for not jumping in. You open up financial news and every headline is screaming about the next big thing, the next crash, the next opportunity you're missing. Sound familiar? Yeah, I thought so. My name is John, and I spend way too much time thinking about why smart people make terrible investment decisions. If you're someone who knows you should be investing for the long term, but finds yourself constantly second-guessing your strategy every time the market hiccups, or you see someone else making fast money, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Today, we're breaking down Warren Buffett's investment strategy as we head into 2026, but here's the thing. This isn't just another video regurgitating the same buy and hold advice you've heard 1,000 times. We're going to dig into the actual psychology and mathematics behind why Buffett's approach works, why it's so hard to follow, and most importantly, how you can actually implement it without losing your mind. Look, Warren Buffett is worth over $140 billion. At 95 years old, he's still running Berkshire Hathaway and still making investment decisions that move markets. But here's what most people don't realize. Buffett's strategy hasn't fundamentally changed in over 60 years. The same principles he used to turn $10,000 into billions are the exact same principles he's using today in 2026. So why isn't everyone doing this? Why aren't we all billionaires? That's the question we're answering today. Here's the thing that's going to sound controversial, but stick with me. Most people don't actually want to be good investors. They want to feel like good investors. There's a massive difference. Being a good investor is boring. It's buying quality companies at reasonable prices and then doing literally nothing for years, sometimes decades. Feeling like a good investor? That's exciting. That's checking your portfolio 5 times a day, reading every earnings report, watching CNBC, trading options, getting in on the hot IPO. A study from Dalbar, a financial research firm, found that over the 20-year period ending in 2023, the average equity investor earned just 5.5% annually, while the S&P 500 returned 9.8% annually. That gap, that 4.3% difference, that's the cost of feeling like an investor instead of being one. Let me put real numbers to this because this is where it gets absolutely wild. If you invested $10,000 in 2003 and earned the S&P 500 return of 9.8%, you'd have approximately $64,000 by 2023. But if you earned what the average investor actually earned, that 5.5%, you'd have just $29,000. You literally gave up $35,000 trying to be smart, and that's exactly what Buffett has been saying for decades. So let's break down what Buffett is actually doing, because the surface-level stuff, buy good companies, hold forever, that's not enough. You need to understand the mechanics. Buffett's entire strategy rests on one deceptively simple concept: intrinsic value. He's trying to buy dollars for 50 cents. But here's what trips everyone up. How do you know what a dollar is worth? Most people look at stock prices and think that's the value. Apple's trading at 180? That must be what it's worth, right? Wrong. The stock price is just what someone else is willing to pay today. Value is something completely different. Here's the psychological shift you need to make, and this is critical. When you buy a stock, you're not buying a ticker symbol. You're not buying something to sell to someone else for more money next week. You're buying a piece of a business. A real business that makes real products, serves real customers, and generates real cash. Buffett looks at businesses and asks, how much cash will this business generate over its lifetime, and what is that cash worth to me today? Let's use a concrete example. Say there's a lemonade stand, stay with me here, that generates $1,000 in profit every single year. If you could buy that lemonade stand, how much would you pay? Well, if you paid $5,000, you'd get your money back in 5 years, and everything after that is pure profit. That's a 20% annual return. Pretty good, right? But if someone wanted $20,000 for that same lemonade stand, Now you're only getting a 5% return. Still okay, but not exciting. This is intrinsic value. The business hasn't changed. It still makes $1,000 a year, but what you pay determines your return. Now scale this up to real companies. In 2026, Buffett is looking at the same thing. He's asking, what will Apple, or American Express, or Coca-Cola generate in cash over the next 10, 20, 30 years? And can I buy it today at a price that makes sense? Here's where most people screw up. And honestly, this is where I see even experienced investors lose millions. Buffett has this concept called the circle of competence. It means you only invest in businesses you actually understand. Sounds obvious, right? But look at what people actually do. In 2021, everyone piled into cryptocurrency. In 2023, it was AI stocks. In early 2024, it was quantum computing companies that don't even have revenue yet. And look, I'm not saying all these investments are bad. I'm saying most people buying them have absolutely no idea how to value them. Buffett famously avoided tech stocks for decades. Not because he thought technology was bad, but because he didn't understand how to predict which companies would win. He finally bought Apple, but only after it had become less of a tech company and more of a consumer brand with a predictable ecosystem. Here's the thing. Buffett's circle of competence isn't bigger than yours. It's just clearly defined. He knows insurance, he knows consumer brands, he knows banking, and he stays there. You might use an iPhone every day, but do you understand Apple's supply chain vulnerabilities, their margin sustainability, their competitive moat against emerging manufacturers? That's the difference. Now you might be thinking, okay, John, I get it. Buy good companies cheap, stay in my lane. But what about when the market crashes? What about when my stocks are down 30%? This is where it gets really interesting, because this is where Buffett's strategy goes from intellectually understanding it to emotionally surviving it. In March 2020, the market dropped 34% in about a month. Buffett didn't panic sell. In fact, Berkshire Hathaway had record cash positions, and he made strategic investments. But here's what you need to understand. Even Buffett's stock portfolio dropped in value by billions. Billions with a B. The difference is psychological framing. When Buffett buys a stock, he's mentally prepared to hold it, even if the market closed tomorrow and didn't reopen for 5 years. Let that sink in. 5 years without knowing the price. Could you do that? Be honest. Most people can't because they're not actually investing. They're speculating with extra steps. They're trying to time when to get in and when to get out. They're constantly recalculating whether they made the right decision. Here's the brutal math on this. Let's say you invested $100,000 in the S&P 500 and held it from 2000 to 2020. Your return would be approximately 6.1% annually, turning that $100K into about $320,000. Not bad. But if you missed just the 10 best days in that 20-year period, just 10 days out of roughly 5,000 trading days, your return drops to 2.4% annually. Your $100,000 becomes only $153,000. You lost $167,000 by missing 10 days. And here's the kicker. Most of those best days happened right after the worst days. When you panic sold at the bottom, you missed the recovery. Let's look at what Buffett is actually holding as we move through 2026, because this is instructive. Apple remains Berkshire's largest holding, around 40% of the equity portfolio. Bank of America, American Express, Coca-Cola, Chevron, these are boring companies, mature companies, companies your grandparents have heard of. Here's what most people don't realize. Buffett isn't trying to find the next Amazon. He's trying to find businesses with sustainable competitive advantages that generate predictable cash flow. Look at Coca-Cola. Berkshire bought it in 1988 for about $1 billion. Today, that position is worth around $25 billion, and it generates over $700 million in dividend income annually. That means Berkshire is getting a 70% cash-on-cash return every single year just from dividends on their original investment. Let me say that again. They're getting back 70% of their original investment every year in pure cash dividends. And they still own the stock, which is worth 25 times what they paid. That's the power of long-term, quality investing. And if this video helped clarify Buffett's approach or made you rethink your own investment strategy, smash that like button and subscribe because I'm going to keep breaking down exactly how money actually works versus how we think it works. Now get out there and start actually investing. I'll see you in the next video.